All right, guys, let's go ahead and start. Thank you all for joining today. I'm Mark Curry, co-founder of SMK Capital Management and fund manager of Alternative Fund 4. I'm here today with Franklin Spies of IWF. Franklin is an investor and business partner with SMK. This will be our fourth investment project working with Franklin. He assists us with various attributes, but predominantly asset selection, due diligence, and capital markets. So thanks again for everyone joining. We really want to start and walk through the details of our latest investment offering, Alternative Fund 4. Throughout the presentation, please ask questions. You can see a Q&A box on your screen. We will review everything at the end of the presentation and look forward to engaging with you in some of these details. I just want to start by mentioning that in today's volatile market, investors are struggling to find ways to preserve capital while also achieving attractive income and growth. At SMK, we focus on three key principles to achieve these goals: diversification, access to high-quality deal flow, and disciplined asset selection. And for over 15 years, we've been helping investors navigate market turbulence, predominantly through private real estate investments. And Alternative Fund 4 continues this approach with a focus on recession-resistant assets where we can earn a blend of income and growth. So let's dive in. I'm excited to share the details of our fund with you. Just to confirm, can you see my mouse moving on the screen here? Yes? Okay, thanks, Franklin.
Yes.
All right.
Okay, well, let's get the standard disclaimer out of the way in that all investments inherently involve risk. You should consult your attorney, your financial and tax advisors before considering an investment. And also that none of the information presented here constitutes an offer to sell or solicit an offer to buy a security. That's something that can be purchased through reviewing offering documents with more details about the associated risks.
Thanks, Franklin.
All right, then I'll just give us a brief overview of the agenda today. So we're going to start with a background on SMK Capital, their track record. We'll move into the benefits of investing in a diversified fund. And then we'll talk a little bit about the market data and why now is an ideal time to invest. Then we'll move into the targeted asset classes for the fund. And then we'll talk about the two specific fund investments that already are within the fund. And we'll close it out with projected investor returns, followed by a time of Q&A for all of you to participate.
Thanks, Franklin. Now, we believe that who you invest with is just as, if not more important than what you invest in. So I want to share a brief overview about us and our firm. SMK Capital Management is a family-owned private equity real estate investment company. We've been providing clients with passive income and growth opportunities since 2010. We've created and managed over 65 individual partnerships with our investors over the years. Brief history on our firm. My father is a retired orthopedic surgeon. He started investing in real estate in the late 1970s. I got my start in 2005. And for the next few years, while I was working in corporate America as a financial analyst, my family members and I were partnering, pooling our own capital together and buying some distressed value-add properties, predominantly at the courthouse steps, direct from the bank. By 2010, I was hooked. I left the W-2 and corporate world, partnered with my father. We formed SMK Capital Management officially. And for the next 7 years, we were really focusing as an operating partner, providing investors access to the investments we were investing in. A lot of it was single family, small multifamily, heavy value add, buy, renovate, rent, and sell. We built a property portfolio of over 60 different properties during that time period. And during that same period, myself and a couple family members were diversifying our own retirement dollars through self-directed IRAs. We were really looking for diversification outside of the traditional stock market, started investing in over 20 different commercial real estate opportunities. And during that time period, we really built up a compelling data set where we could compare risk and reward, different operating partners, different income streams. And we pivoted our focus from an operating partner in 2017 really to specialize in what we continue to do today, which is private equity real estate investments. We utilize the relationships that we've built with other firms across the country to access a lot of what we consider to be high quality deal flow. And our focus in 2018 shifted a lot to recession resistance, where we can select assets and investments that are lowly correlated to the overall market, that have a historical track record of being able to perform in varying market cycles. And today, our investment criteria, what we look for from a fundamentals and return standpoint, usually looking for 3 to 7% cash flow starting in the first year, an average of 7 to 12% cash flow while we're holding the asset. And then we like to achieve, an average annual ROI or IRR of 13 to 20% over the hold period. That typically equates to an equity multiple of a 1.5 or 2.5x on invested capital. Now, today we're screening anywhere from 10 to 20 different investment opportunities every month. We invest in a handful every year. And so we've curated a process where we're quite picky. In particular, we say no to about 98% of the investments we see, really trying to find those where we think there is a outsized return for a limited amount of risk that we're taking. Here we summarize the syndicated real estate investments that we have invested in with other operating partners. These have all gone full cycle. You'll see our average IRR is on these investments is 23%. Quick disclosure, of course, historical performance is not indicative of future results. All right, let's shift gears. We'll talk about some of the benefits of investing through a diversified fund. I'll start here with, lower risk and more resilience. Funds that combine multiple asset classes and properties together can provide the upside of investing in a specific deal, but also still offer an additional layer of downside protection that you won't get when investing in any single asset. So if you think about it this way, if one property in the fund is underperforming, that downside may be offset by the portfolio's overall positive performance. Really focusing here on capital preservation and downside protection. And a diversified fund can provide us the potential to achieve significant diversification. And we think about it a few ways, but we want to spread capital across operating partners, geographies, properties, and asset types, and also strategies. We like to blend income-producing assets with value-add strategies, which allows us to diversify across different risk profiles, really focusing on, again, recession-resistant sectors.
Great. I'll cover a few more key benefits of investing in funds, such as the ability to leverage the experience and network of fund managers like Mark and myself, our industry experience, our vetting process, and gaining access to more deals and operators. Further, we obtain better terms from our operating partners by aggregating all of our capital and investment dollars together, allowing us to negotiate higher returns and splits, lower management fees, an ability to bypass higher investor minimums, which, as we know, can sometimes be beginning at $250,000 when investing directly. Our fund allows us to reduce that minimum. And then there's also the efficiency of only having to log in as an investor into one portal online and being issued a single K-1 for tax reporting, when typically you'd receive a file, have to file one for each different sponsor. And moreover, as fund managers, we often get more of the operator's time and attention, having personal relationships with them, many of them, throughout the life of the investment, allowing for more transparency and oversight than one may otherwise achieve on your own. And finally, the fund is completely passive for you as investors with all of that, the loan underwriting and the financing through our accounting and bookkeeping team, the asset management, all taken care of, all with a single point of contact, ultimately leading to the fact that investing in a fund still generates favorable tax benefits with an estimated of 20 to 40% passive losses in year one in this fund.
Thanks, Franklin. Yeah, we'll see if that changes, by the way, guys. There's potential for the new administration to provide more favorable accelerated depreciation benefits. So if those laws pass this year, we'll see the most likely see passive losses in the first year increase beyond the 20 to 40% estimate here. And in summary here, really what our goal and mission for our fund is to protect investor capital and to deliver attractive risk-adjusted returns over a 5+ year term, targeting both income and long-term growth.
And I'll jump back in here. This slide, as you can see, really captures the overall targeted blend and allocation of this fund. So as you can see, it provides consistent income and growth. It targets diversification across multiple investment strategies. And we're estimating, approximately 15 to 30% of the fund is going to be allocated towards fixed income investments, which we'll talk about here shortly. Also, with 65 to 80% of the investments that provide both income and growth. And lastly, about 5 to 15% of the fund is intended to be allocated to opportunistic growth investments. And we believe this combination, this allocation achieves a favorable blend of everything attractive to investors in any market by combining positive cash flow, favorable tax benefits, while still allowing for ample growth on invested capital. Now let's jump to this another slide. Let's shift a little bit to talk about some of the market data and trends that we have really found compelling. We want to share with you that help answer the question of why now? Why invest in a fund now? So jumping into this first slide, over the past few years, commercial real estate sector has undergone a significant reset with asset prices declining on average by about 20%. That's significant. This type of historic correction has not been seen in over 15 years, since about the global financial crisis of 2008, 2009. That was a period that created generational investment opportunities, which we think is on the precipice now. And as Mark will further demonstrate with current market data, you'll see that asset values are currently stabilizing. Therefore, time is on our side. Mark?
Sure. Yeah. Let's take a look further at some of these trends, guys. This here, what we want to review is the commercial real estate property valuations. And this is a chart from Green Street Advisors. This is essentially showing us the change in commercial real estate property valuations going back to 1998. And now this includes 12 different real estate sectors. So it includes offices and malls and apartments and self-storage, really encompassing kind of a pretty broad view of the market. But what I want to point out here is if you look at the time period in 2008 or so, during the last recession, last major recession, we saw a drop in valuations of around 20%. Okay. And then valuations picked up all the way up until this inflection point, which was the onset of COVID. We saw valuations drop very quickly, of course, overnight. And at that point, once the stay-at-home orders lifted, we saw valuations really go skyrocketing up and to the right. This period was when we also saw significant inflation of CPI reaching over 9%. And the Fed stepped in and started battling that inflation by increasing interest rates at the fastest pace in 40 years. So a lot has happened, but essentially what we've seen since that increase in interest rate trend is valuations have dropped again about roughly 20%, as we're noting. Now, if we fast forward to mid-2024, you can see the rest of this chart here in blue. We're starting to see increase in property valuations again. And if you recall what's happened here, the Fed stopped raising interest rates and they actually started cutting them in 2024, which provides a lot of clarity to buyers and sellers as to what their borrowing costs will be when they're trying to acquire property. And so we've really seen this trend provide us with some signals that we are at an inflection point, and now could be a great time to be getting in. Again, markets move in cycles. What we're trying to share with you today is that it's likely that the commercial real estate sector is moving past a challenging phase from 2022 to 2024. Now let's talk about the credit markets. Quite important to transactional volume is the availability of debt, credit, and the ability to borrow against real estate. We've seen a pretty significant increase in available capital from the reentry of banks, debt funds, other lending sources competing for high quality deals. So what we're looking at here is the increased liquidity, which is driving transactional volume. And I want to share with you the trend again, comparing to 2008 and 9, the recession. You can see this drop in real estate transactional volume. Pretty significant, of course, from 2007 to 2009. It was very hard, if not almost impossible, to borrow money against commercial real estate assets. The lending markets had dried up. That is not the case today. There's a lot of liquidity out there. Financing is readily available. But you can also see a similar drop in transactional volume over the last few years here on the right. What's happened here is a different effect that's caused transactional volumes to drop, predominantly due to COVID, a rise in inflation, and a significant increase in interest rates over the last few years. But you can also see that things are starting to turn a corner again. Transactional volume is increasing over the last year or so. So there's some recovery signals to summarize here. Increased liquidity provides healthy markets. We've seen interest rate cuts. We'll see if there's more to come this year. And this is all leading to more transactions happening, all part of some of the same trends in pricing.
Great. Let's talk a little bit about cap rates as a metric for the market as well. After 7 years of rising cap rates, the market appears to be nearing its peak. Now, remember, with cap rates reflecting the asset value based on an asset's net income, when those cap rates start to compress after a property is acquired, it creates value. So when cap rates rise, it's correlated to falling real estate values. But recent data is showing that the cap rates look to have plateaued, as you can see there by the arrow pointing to that plateaued area on the line, and they're expected to modestly compress throughout 2025, again adding value. According to some recent data from JLL, a global leader in commercial real estate and investment management, multifamily and industrial cap rates are projected to decline over the next 12 to 18 months. This further reinforces the strategy that a new market cycle is underway and that now may be a good and opportune time to invest.
Okay, so with the current market in mind, which asset classes or real estate sectors are we targeting that we believe are best positioned to preserve capital and grow through this next cycle? Let's review them quickly. The first is triple net industrial. We're also targeting private real estate debt, self-storage, mobile home parks, and multifamily apartments.
Okay, I'll tackle industrial. Mark and I continue to like an industrial, and this asset class is projected to continue thriving through the next market cycle. Now, this particular sale leaseback industrial strategy that we're employing or our key partner is employing has significant additional advantages. For example, this is where existing well-established full operating industrial businesses are first identified. And then they agree to sell their underlying real estate to our operating partners. Again, often they prefer not to be in the real estate business. So the seller in this scenario becomes the long-term in-place tenant as they sign a 10 to 20 year triple net lease, receiving an infusion of working capital for them to now grow and expand their operations. So this creates a stable long-term asset for our fund. So as investors, we secure a low average loan at that point and are insulated from future increasing expenses which is a great hedge against inflation, where the tenant is still responsible to pay all property level expenses. All the while, this increases cash flow through pre-negotiated rent escalations in the lease, typically about 2 to 3% annually. And this, of course, then drives the predictable NOI growth, creating further appreciation and value over that holding period.
Great, thanks, Franklin. Let's shift over, why fixed income and private real estate debt. Essentially, it's a lower risk investment. Our capital is lent as a bank would lend money to real estate owners. It's secured by hard assets, helps reduce downside risk compared to, equity investments. And we'll typically see higher yields than traditional fixed income investments such as bonds or REIT dividends. So we really love fixed income investments and debt funds for their predictability of cash flow. Next, we're targeting self-storage. Again, we're not going to go through everything on the screen today. We want to be cognizant of time, but a few highlights here. 11% of Americans rent a storage unit, so it's a massive market and demand. Contracts are month to month, so rents can be raised on 30-day notice. That's helpful in up markets and down markets where you can adjust the rental rate in order to maintain occupancy. And you can also see back to 2008, the track record of self-storage has been positive through multiple market cycles. Some of the storage REITs during that downturn were still delivering a positive return, while other REITs were significantly down. And lastly, it's a low overhead business model. We have very low operating expenses compared to other real estate sectors that typically provides a nice margin. If you think about that as an inflationary defensive move, utility prices have skyrocketed on many assets over the last several years. Self-storage is somewhat defensive in that nature where there's low plumbing, electricity, and gas infrastructure. It's also relatively easy to maintain these assets with minimal staff. Let's shift now and talk about mobile home parks, why we love this sector. It's a very unique business model in that the mobile home park owners typically rent the land to the residents, and a lot of them own their own home. And so, again, this results in low operating expenses where the residents are responsible for maintaining their own home. And an interesting stat here, 90% of mobile homes are never moved. And if you think about the lot rent that they're paying is usually $300 to $500 a month. And so to move a home can be, $5,000, $10,000. It becomes quite cost prohibitive. We have a pretty long-term thesis at our firm. We love affordable housing as a sector because of the demand. We don't think that's going anywhere. It actually is increasing based on a lot of data. Currently, 20 million people are living in mobile homes in the US, and it's one of the most affordable housing options available. Limited supply is a big variable in this real estate sector that you don't see in a lot of others. It is very hard to build a new mobile home community in a desirable location due to zoning restrictions, just not wanting them in certain municipalities. There's also a lot of advantageous tax benefits, including accelerated depreciation. And lastly here, market inefficiencies. The vast majority of mobile home parks are owned by mom and pop sellers. A lot of times they are mismanaging or undermanaging the asset, which provides the opportunity to really grow value with professional management. Franklin, turn it over to you.
Thanks. And the last sector we'll highlight is multifamily. So apartment living supplies the majority of our nation's affordable housing, with consistent demand in virtually every market with the rising barriers to home ownership. So let's take a look at this slide. which further highlights the immediate demand as RealPage is reporting in the first quarter of 2025 that absorption of apartments is hitting the highest points in 30 years. Another indicator of great opportunity. And okay, so apartments also provide compelling tax advantages, much like many of the other assets we invest in. But this time through cost segregation studies, accelerating depreciation, along with the ability to achieve income and growth through annual rent increases, billing back of utilities, and the ability to renovate apartments and charge higher rates with nicer finishes. And that creates that forced appreciation concept. Again, multifamily is the largest real estate sector in the US with the most amount of transactions of any asset class. This increases the likelihood that there will be buyers when it's time to sell. And there are favorable financing options as well in multifamily, specifically through agency debt, Fannie and Freddie, which improves leverage and terms. Now, our preferred operating partners in the multifamily space further enhance returns through additional strategies such as a value add or tax abatement strategies.
All right, now we just want to share with you some exciting starts of this fund. We've identified the first two investments that we're going to make, and we want to review those with you today. The first is our industrial sale leaseback portfolio. This provides an income and growth strategy. And the next is into a private real estate debt fund that is a fixed income strategy. So let's talk about triple net industrial sale leaseback portfolio. Again, this is an income and growth strategy, first targeted investment for our fund. And we're excited about this. It's a portfolio that we're investing into. It's made its first acquisition. Our operating partners have acquired 6 properties in 3 states, with Robbins Sports signing a new 20-year triple net lease. That's the tenant. And this is part of a growing portfolio. Our operating partners are scheduled to close on 7 additional acquisitions in Q2 of 2025. And our capital will be spread across all of the assets in the portfolio. So even just within this one investment, we have a pretty significant amount of diversification across properties and regions. One attribute we like to look at pretty closely here, we're looking at this, what we call positive spread between the going in cap rate, which for these acquisitions is around 8%, and the fixed rate debt interest burden of around 6.5%. And so this positive spread is helpful in providing our fund with projected cash flow in year 1 starting at around 5 or 6%. This portfolio is fully audited by Eisner Amper, again helping reduce risk. And our fund is projected to earn 15% IRR and a 1.8 to a 2.0 multiple on invested capital or equity multiple, with an average cash flow of over 7% over the 5-year portfolio duration. Franklin, back to you.
All right, let's highlight a bit further this Robbins Sports surface that Mark mentioned, which is the first industrial asset already in the portfolio. They sold their real estate, as I mentioned before, and they signed the long-term triple net absolute lease. This company's been in business since 1894, if you can believe it. They manufacture hardwood flooring for gymnasiums around the country, having contracts with the NBA, for example. And one unique attribute which stood out is that they source all of their wood domestically in the US, as the dryness and composition is superior for athletic flooring, which again further insulates them from global supply chains or global supply chain issues. Now, Robbins operates out of 6 locations. So you can see this is not a small organization. With these assets already acquired and in this industrial portfolio. So let's just look at some of the metrics here on the right on the slide. Just look at the diversification. They're across 3 states. There's 6 locations. They're being acquired at above an 8 cap with low loan to value, all with long-term triple net leases with rent escalations in the leases.
Yeah, so really our fund is targeting investments that have a positive spread. I want to dive in a little bit more about this, where the going in cap rate exceeds the interest rate. And this means that the properties generate rental income at a higher rate than the cost of capital. It helps reduce risk, it helps support positive cash flow, and enhance overall investment returns. Now, our operating partners here in the industrial space have several deals that are in their pipeline that are expected to close soon, which I want to highlight here. The first one's already been closed. That's Robin Sports that we just reviewed. And then there's 7 more that are scheduled to close in Q2 of 2025. What I want to also mention is the cap rate versus the interest rate. This is the positive leverage that we love to see. We got an estimated 1.73% across this portfolio as it starts to grow here. Okay, one quick point. This slide is really showcasing the trend in net lease cap rates. They're currently at 10-year highs. You can see this in orange. This is favorable for us. You know, the previous slide showed the cap rates, a lot of them starting in the 8% range, just creating a very favorable time, historic pricing opportunity, strong potential for growth here, and a good time to be investing in this sector. Let's move on to the second investment that we've targeted for the fund. This is a fixed income investment into a lower risk debt fund. For this investment, again, we're essentially the bank. Our capital is being lent in a first position lien. So it carries less risk than an equity investment, but it also doesn't have any upside. So you have to think about this as fixed income. Now, the debt fund allocates capital through short-term loans, predominantly to multifamily and senior housing facilities that are eventually seeking long-term HUD financing. And for those of you that may not be familiar, HUD is a department of the government. They insure loans through the FHA, the Federal Housing Authority, and these loans are known for their desirable 35-year terms. But getting a HUD loan can be difficult. It comes with a long lead time, usually 9 to 12 months. So this debt fund operates in a very niche space where they are bridging the gap with short-term financing while the borrowers prepare their assets for HUD takeout refinancing. Now, in 2024, our operating partners here were the second largest HUD lender in the country, and the fund that we're investing into has over 3.1 billion of loans across 128 loans in their portfolio. And so even again, just within this one investment, we are quite diversified across over 120 loans. Now, further diversification is achieved here by lending capital across various strategies. So this includes value add, you can see the pie chart to the right, stabilized, and a small allocation into construction financing. Again, we like to see that allocation as to what the borrower's use of the capital is being used for. Our operating partners have a very stellar track record. This fund here has a low default rate of only 0.2%. It has been providing investors with consistent income since 2019. And it also provides us attractive liquidity, allowing us the flexibility to redeem our principal after the first year invested. This fund is also fully audited by Grant Thornton, again, helping reduce risk. Now, our fund is projected to earn from this debt fund annual income in the range of 10 to 13% with limited variability of return. Now, here I just want to highlight the monthly net returns that this debt fund has been achieving and providing investors. On the left, you can see the year of 2019 up to 2025, the monthly return, and then the year-to-date annual amounts in the right. So really excited about adding this into our Fund 4. All right, let's go ahead and review the financial projected returns for the fund. We have 3 class shares for investors. We're starting with Class C at $75,000, Class B minimum of $250,000, and Class A minimum of $500,000. What you'll notice here is we have a pretty simple cash flow and profit split structure. This helps reduce the administrative and accounting work behind the scenes. And really, by doing this, we're avoiding preferred returns. There's no hurdles. It's a very simple process to follow, where investors earn between 80 and 90% of the net income that comes into our fund from operations and property sales. Again, no limit on the upside there. SMK earns the difference of 10 to 20%, depending on the class share. Now, this structure is a little bit higher and more advantageous from a split perspective than you might see in other funds where there is a preferred return. And so we've just created an incentive here to ensure that we're, selecting cash flowing and high profitable investments, and helps keep the fund accounting much more straightforward. Now, the result is a projected equity multiple of a 1.5 to a 1.7x, that's net to investors, and 11 to 16% weighted average annual ROI. Here you can see the initial projected cash flows. Again, we are focusing on providing cash flows starting in year one. We'll see where this lands, guys. We are early on in the fund, just opening it, targeted our first two investments. And so this could fluctuate as we add more investments to the fund, both up or possibly slightly down. We don't anticipate it to go much lower than there, though. The further years, 2 through 5, you see increasing in cash flow as projected. We have an annual management fee of 1% on invested capital and a one-time acquisition disposition fee of the same. We're projecting an investment term of 5+ years. We say plus because some investments will be shorter and some investments will be slightly longer, but most of them right around a 5-year projected duration. And we anticipate beginning to return principal to investors in earlier years 2 through 4. That's really through redemption of debt fund investment and also through some properties that are likely to sell or refinance and return principal. And so as principal is returned from these capital events to our fund, we then turn around and return it to our investors. It really allows for people to reduce risk. Anytime you're getting money back, you can go take that capital, put it into something else, compound your return, and still earn distributions and profits on the remaining assets in the fund. We do investor distributions quarterly with reporting as well. And our timeline here, you can see our first tranche funding deadline is Friday, May 2nd. The reason for that timing, guys, we obviously want to invest in both of the assets we've targeted thus far. The triple net industrial sale portfolio has some closings in the middle of May. If our capital is put to work prior to that deadline, it starts to accrue a return right away. And so there's a bit of a time constraint there. We will continue to keep the opportunity open past the 2nd, of course. But what we're doing to incentivize early investment is we're providing a management fee promotion, which you can see here. These are our founders' shares. So for the first year and a half, we waive our management fee for investors in the first $1 million into the fund. And so again, an incentive to early folks. It helps us get the fund up and running. We've already got a number of commitments for founder shares. So if you are interested in the opportunity, let us know. These are on a first come, first served basis. If you are considering an investment greater than $1 million, perhaps by combining multiple parties together, just let us know. We can provide a discussion of some special terms for that allocation as well. Okay, guys, next steps before we turn it over to questions and answers. For those of you that want to learn more, log into our investment portal through our website. We've got some interviews with our operating partners you can listen to, a lot more details on the fund, and that would be where you would go to proceed with making an investment to access the offering documents and the wiring instructions. My contact info is here on the screen. Feel free to email me. We can schedule a call, go back and forth with questions. Happy to help. So thanks, guys. Why don't we open it up to the Q&A section of the presentation.
Hey, we did pretty good on time.
Not
Mark,
bad.
why don't you
Yeah.
I'll quarterback this a little bit. We've got a question that I'm going to pose to you that maybe you can answer from one of our guests here. For triple net industrial, how is the depreciation compared to multifamily?
Good question. So it's quite similar. In this specific portfolio, our operating partners plan to do cost segregation studies, which helps provide a good amount of depreciation and passive losses. And so they're estimating, again, assuming that the administration doesn't change the current tax law and depreciation benefits, they're estimating around 20, maybe 30% passive losses from the depreciation into this fund. And so compared to multifamily, quite similar. Sometimes you'll see more in multifamily. There's oftentimes more, I would say, items within the community of a multifamily property, like appliances, that you can depreciate at a much faster schedule than you might in a typical warehouse.
Yeah, the only thing I would add is on those tax questions, of course, consult your tax professional. And then also the consideration is, you're really looking at the improvement value of the asset, right? You don't depreciate the land, you just appreciate the improvement. So the real distinction is the improvement value of the apartment complex versus the improvement value of the industrial property. Mark, here's another one for you. How many other investments are we looking to add, and what types of investments are we considering?
Yeah, great question. So we have put together an anticipation of this one, a slide, which I'll share with you in a second. But we're always looking at opportunities, guys. It's almost a daily event of screening deals to see what will be advantageous for the fund. And so let me share with you here a slide of some of the additional investments in due diligence. And I'll just caveat this with, we're in due diligence on these. Some of them won't pass. We will not invest in them, and others might. And so here's what we're looking at the moment. We have first here an income and growth investment. This is in a mobile home park in about 10 minutes from downtown Sarasota, Florida. One of the unique attributes we like about this that we don't see very often is that the community has 60 vacant homes already in it. Those can be renovated, they can be sold, and then the owners of those homes will pay lot rent, which in this market is over $800 a month. And so a lot of value add potential there. And the cost to sell the home is almost irrelevant. You could sell them for $2,000. That's not why you're in it. You're in it for the lot rent, which grows the net operating income of the community. So we love this investment. We'll see where it goes. We're also looking at another income and growth investment. This is in an industrial outdoor storage fund. Some of the attributes we like here, a nice unlevered IRR of 15%. And so their underwriting assumes no leverage. That's where you're getting the 15%, although they do anticipate to put about conservatively 50% leverage on these assets. Income and growth, we just got on our desk this tax exempt apartment opportunity just in the last 5 days. This is 15 minutes from downtown Seattle. We love this sector. We kind of briefly talked about it earlier, but essentially for providing affordable housing, and this is an apartment community, it's already, I think, 93% occupied, you are able to get a property tax exemption. So the property doesn't have to pay property taxes. And that is usually good for 99 years and transferable to the next buyer. So really like this opportunity. We'll see where it goes. The attractive pricing caught our eye. Pricing, the comps go back to 2016 from what we've seen here. Positive leverage, we love that. As we mentioned, this one's got about 170 basis points at the start, so really attractive. Another fixed income investment we're looking at, this is into a diversified private debt fund, very niche lender. They've got over 80 loans in the fund right now. And what they're doing is lending money to fix and flip borrowers, predominantly in California. Investor returns are at about 9.5%. Two more that we're in due diligence on. There's another fixed income investment, promissory note net lease fund. This fund consists right now of $100 million of equity, and they've been providing 15% annual return to investors since 2018. It does have more risk than some of the other debt funds that we like to see because of the lack of collateral, right? This is a promissory note. And so In the debt fund that we've selected for our fund, there's collateral. We're in first position against the real estate. So if there's an issue where the tenant, or excuse me, the borrower isn't able to repay, you could foreclose and then recoup your principal back through that process. Not the same collateral structure in promissory note, which is why you see a higher return here, right? It's a little bit higher risk. Lastly, I think worth sharing today is this growth opportunity that we're looking at as we speak. This is into a phase 2 multifamily development. We might have an opportunity to fund in the last capital. Phase 1 and phase 2 of these developments are right next door to each other. Phase 1 has already been built and fully leased. There's essentially a little bit of a waiting list, and they've already started construction on phase 2. And so one of the things that we look at with development deals is the lead time from when you invest until the project is complete. Usually that's a few years. And so we don't often do a lot of development deals because they're higher risk, of course. This one has a potential lead time of about 1 year or so, as they've already started construction. And so that's one of the attractive attributes on this opportunity that we don't see that often. Quick quote, Franklin, that you and I were just talking about, but Ray Dalio, the most important thing is to have a strategic asset allocation mix that assumes you don't know what the future is going to hold. So just leave that with you there.
Yeah, Mark, I think that provides a good opportunity for the participants to realize that while we selected two, we're continually, and you largely take the primary lead on this, are continually reviewing deals that come in and doing due diligence and meeting with, talking, having conversations with the operators, getting into the details and the background of their deal rooms and all the information that's necessary. And you pass on a lot, given all the deals that are coming across our desk.
Yeah.
Here's another one, Mark. How long do we intend to keep the fund open?
Yeah, it's a good question, right? So we just opened it. We still have some founder shares available. We'll see how long that lasts. But we anticipate to keep the fund open for at least a few months. We want to ensure that we have enough time to build the fund out the way we want to. So, usually people are also asking, well, what's the size of the fund? How many deals do you expect it to be in there? And we'll see, but our target is usually around 7 to 10 different investments inside the fund is the goal here. And so we don't have a predetermined schedule, but probably at least a few months we'll leave the fund open.
All right. I've got another one here. Let me just make sure I get it right. Is that so different than an individual project where you're buying a single asset, you hold it for 5 years, and then you sell that asset, and then everybody gets, the fund essentially closes and people get their money back and you participate in the appreciation. Well, here you've got multiple assets in a particular fund. So how
You
can
guys,
investors
let us know what you want to do.
Sorry, Franklin, just muted that.
Okay. It's a bit more complicated, and maybe that was the impetus for the question, is that how can they anticipate getting their money back if each of those assets aren't sold on one particular day to close out the fund?
Yeah, great question. So when you have a diversified fund with a multitude of assets in different regions with different operating partners, of course, it can be a bit hard to predict when you're going to get your capital back. But what we've seen in our experience and the types of investments we're targeting, most of them are 5-year durations. And so inside each investment, there is a projected and estimated exit timeframe. And so like the triple net industrial portfolio has a 5-year projected duration. Other investments, including the private real estate debt fund, are likely to be shorter, where we can acquire the portfolio, build the portfolio, and then within, let's say, 2, maybe 3 years, some of the value add investments that we might put in the fund will start improving performance. They would have renovated units, increased occupancy, and start kicking out more cash flow. At that point, we're likely to redeem our interests in the debt fund, return that principal to investors, and continue to hold the assets that have income and growth. And so that's how we look at it from an allocation and a disbursement standpoint. But essentially, there's going to be chunks of investor principal coming back, starting around years 2 or 3, and likely annually going forward as underlying assets are sold, refinanced, and we redeem our interests from debt funds.
Yeah, I think it's good to highlight what you said is that as these capital events occur on individual assets, that capital that comes back to the fund is then distributed back to investors as a return of capital.
That's right. That's how we do it, right? So that can help reduce risk for investors. They get capital off the table. And, there's always a scenario, we don't underwrite to this, but we've had it happen a number of times where we still own assets in the portfolio. We're still doing distributions, but investors have received all of their money back through principal return and through refinances, property sales. And so that to us is a ideal scenario. If we can achieve that, we'd be quite proud of it. And we'll see where it goes. But of course, if you're invested in a fund and it's providing you with income and distributions, but you have no capital at risk, that is essentially a win-win for everybody.
Mark, we're approaching the hour mark here. We want to be conscious of everyone's time. Let me give you one more here that just came in. If someone is interested in, let's say, just storage or one particular asset class, and maybe not another, this offering is for a fund that's diversified. What would you say to the availability of it being able to invest in just one of these sectors?
Yeah, I'd say, look, it's an option. It's not the investment offering we're discussing today. And so just reach out to us. Let us know what you're interested in. We can discuss and see if we can make that work. I see a question here, Franklin. What is the cost of the multifamily homes and the mobile homes for buyers? Okay, so I want to answer that. Most of the multifamily units that we target for investment are affordable by definition, right? So the area median income where the property is located can afford the rents. And so what does that mean? It means, most of them are blue collar type workers, police officers, teachers, healthcare workers that are looking for apartments anywhere from $1,000 to $1,500 a month in rent for a 1 or a 2 bedroom. That's usually where we're focusing our investments. We don't do a lot of what we call Class A apartment investing, which was just built and has high rents and a lot of flashy amenities, and those tend to be north of $2,000 a month for the end user. Now, as far as mobile homes for buyers, so most of the mobile home parks that we invest in have a lot rent of $300 to $500 a month. Some could be higher if they're really in a very attractive location. But that's the sweet spot that we see a lot of the deals come in at, where the residents that are living in their home and owning their home are paying $300 to $500 a month in lot rent. If they want to purchase a home, right? If we want to increase occupancy, it's interesting, but the sale price doesn't always matter that much. And you might say, well, why is that, right? And so think about it this way. A mobile home park's main source of income is from lot rent. We don't want to be in the business of owning that home and then having to upkeep it and maintain it and deal with turnover costs when the tenant moves out. So we try and have a low amount of rented homes, right? We want the homeowners to own their home. And so in the case example we're looking at in the investment in Florida, I'll just switch screens here. This mobile home community has 60 vacant homes. And so the business plan there is to renovate them and then list them for sale. Even if you sell them for $2,000, right? That is a loss on the cost of that home, which is perfectly okay and in the business plan. It's part of the CapEx money that we anticipate. You don't even really budget much for the home sale price as a revenue item. What you really want is that lot rent. And so if you can sell that home for $2,000 a month, now that resident owns their home and they're paying, in this case, north of $800 a month in lot rent. That generates a lot of value for the community. And so I hope that helps answer the question regarding the rental costs for apartments and mobile homes. What else do we have?
It does.
Yeah.
Well, what else would you like to share, Mark, before we wrap it up? I'm not seeing any other coming in. We have some other FAQs that folks can review in the materials circulated afterwards. They can certainly reach out to us with further questions.
Yeah, I would just say, take a look at the details in our investor portal on our website. Let us know what questions we can answer. Happy to have a dialogue and talk through anything that might be relevant for folks. And we're excited about the time frame and the ability to get into these asset classes right now. We really do believe there's a ton of data and trends, and we're seeing it on the ground too from our operating partners, pointing to it being an ideal time to get in. So we thank you all for your time today, for joining us. Again, reach out with questions, and we'll talk to you all very soon.
Thank you, everyone.